I'm Chris Preston.
I'm Brad Zimmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network, which has been delivering investment advice for more than 55 years. Brad, condolences. Your alma mater did not win the national championship in basketball last week, like I thought they might. Uh, Congrats to Michigan, which is actually my mother-in-law's alma mater. But
Your
yeah,
mother-in-law, who you famously love very, very much. We've talked about that on this podcast.
yes,
Yeah,
yeah,
it it was a good run. It would have been nice if they didn't get embarrassed and just blown out of the arena in that
yeah.
last. But
Final
uh,
Four is still an accomplishment.
yeah, I mean, I guess when you're undefeated for the majority of the season and like a consensus number one, and then these two rough losses, you finish number two, like not winning the national championship falls a little bit
Yeah.
shy of that, but cool. I don't know. They just that last game just left a bad taste in my mouth.
Yeah. Yes, it wasn't close. So you're not of the everyone deserves a trophy generation. We must be of the same generation then. What is that?
Yeah,
What generation is that? That's not millennial. That's
no, that's what they say is true about millennials, but it's not like we were asking for participation trophies. They were foisted upon us.
right.
I don't have as I mean, like you can look at my office. I don't have there's no participation trophies on these walls.
Yeah. If there were, we'd have how many episodes are we now? Like 150 episodes, something like
Something
that.
like that.
Yeah,
Yeah.
we participate in this podcast every week. By the way, it is Friday, April 10th. The timestamp it, a little before 11 a.m. Eastern, much earlier for Brad. Brad, tell people if you're awake enough, tell people what we're going to talk about today.
We're going to talk about the market rebound fueled by the ceasefire. Talk about CPI and inflation data that came out this morning, and then there's a little bit of PCE data that came out earlier this week. We will talk about space stocks having a little bit of a moment, and then Mish Schneider of MarketGauge, who is a guest that you may remember. We've had her on previously. She's going to join us, and she's going to do a deep dive into the market with us.
But first, as always, is our Defend the Take. And Brad, you're up this week. And your take, for which you have 90 seconds to defend, is that the SpaceX IPO could trigger a Tesla re-rate. You have 90 seconds. Go.
Okay. So we have talked before. I have made abundantly clear that Tesla is overvalued, right? People buy Tesla for exposure to Elon Musk and to the promises that Musk makes and the developments. And if you valued it like a car company, it'd be worth like 10% of what it's worth now, right? Like there is one analyst. If you look at like Yahoo Finance for analyst price targets, there's one guy that keeps a target in the mid 20s because that's what fundamentally, if you value Tesla like a GM or whatever, it should be worth. Um, Elon Musk owns about 15% of Tesla shares, and he does have. We talked about his contract, or with the deal that he's got where it'll make him a trillionaire if Tesla hits like um, these specific benchmarks over the next couple of years. We talked about that on the podcast previously, sometime last year, I believe. The issue though is Musk owns 44%, maybe 42%. It depends on your sourcing. PitchBook was saying 42% of SpaceX. If SpaceX IPOs for $1.7 trillion or so, that's worth $500 billion to Elon Musk. The the sort of the Tesla Super Bowls that have largely been responsible for the incredible performance of the stock over the last 10, 12 years, there is nothing fundamental about Tesla that keeps their loyalty there. It is
Okay.
entirely possible that the Tesla fanboys sell Tesla to buy SpaceX, and Musk's ownership aligns his interests more with the performance of SpaceX than it does Tesla.
Yeah, yeah, it's a good take. And there may be something to that. You're right that a good percentage of what people buy when they buy Tesla is Elon Musk. Although I would argue that in the last year, a good percentage of the people selling Tesla are selling Elon Musk, or maybe that's more selling their Teslas or avoiding buying Teslas has been Elon Musk is that the brand has been tarnished there a little bit. Um, it's not going to go to 20, but it's come down quite a bit. I just can't. I keep coming back to, and yeah, maybe SpaceX changes the calculus for this entirely, but every time people have been counting out Tesla over and over for like the last 8 to 10 years. The word re-rate has been in there quite often, and keeps roaring back, and it's always on promises, not always kept, but the promise of now it's AI, self-driving technology, robots, whatever it is. Um, you could be right that SpaceX changes that, but I'd be shocked if it really comes crashing down to earth, especially after it's already pulled back, what, 25% or so this year,
Yeah, I think 30 off its December highs.
30 off some, yeah,
Uh, but so I mean that is a totally fair point, right? Like you mentioned robots, like the Tesla Optimus robot.
yeah,
There's certainly a version of this where Musk puts up like firewalls between whatever the intellectual aspirational business developments are, where it's like, okay, well, robotics is all in Tesla because we already have factories and factory automation, but then AI goes with SpaceX because we're going to launch servers into space. Like I think there's probably a version of this where maybe Tesla just keeps grinding lower and then SpaceX pops and then the sort of the aggregate market cap between the two companies just sort of like levels out where some people are Tesla people and some people are SpaceX people. There's also a version where Musk merges the two companies. I don't know, obviously with his pay package having a ton of incentives built in, I don't know if he's going to want to like renegotiate pay packages in the event of a merger or something like that. But he
yeah.
is also the largest single shareholder. If he says that SpaceX is going to sell to Tesla, he could do it. But why go through all the hoops of doing the IPO if you're just going to restructure other than just like a cash injection from the IPO process itself? Um, I yeah, I do think it'll be a drag on Tesla shares at least.
Yeah. Yeah, we'll see. The question is where Tesla shares will be when it comes public in, what is it, June? We'll get more into that. Um,
I think that's the expectation is
yeah.
June at the earliest.
Yeah. So we'll see where Tesla is once that does come public, which leads me into the stock market. Hey, we finally have good things to talk about. I guess we did a little bit last week, but that was pre-ceasefire, 2-week ceasefire. Ceasefire in quotes. I don't know if that's fully being abided by all sides. But it's been good for the market this week. About a 3 to 4% rebound, depending on the index this week. And the VIX is down below 20 for the first time in more than a month, basically. And there's optimism. Now, is it temporary? Who knows? Or could this be a pathway to an end to the war? We'll see. Predicting what will happen there is truly a fool's errand.
Yeah.
But the market, it's up 7% in 7 days. That Mike Santolo cited that, and that's only happened like 10 previous times since 1950, and every time the index has been higher by double digits a year later, double digit percentages a year later. So seems like a good omen. Will it last? Is this going to be a V-shaped recovery like we saw literally almost on this date a year ago? Or is this sort of a false start before, further shakeout? Um, hard to say based because it's so news based, but what say you?
I'm more inclined to think that the market closes the gap back to the downside, back to like the 6,600 range, right? Like if we look at what happened in the context of how close does this look to like Liberation Day,
Yeah,
um, the market sold off from last year from February 14th to March 14th, so like a full month. This year sold off from February 27th to March 27th, so a full month. And then after Liberation Day, it fell another 10%. Obviously, it didn't bounce back in the same way. There was I was reading an article that because it blew through both the 50 and 200-day moving averages. There were only like 9 instances of that since 1956. The only 40% of the time was it higher 3 months later, but pretty much every time it was higher like 6 months later.
Yeah.
So it doesn't seem to portend. I think the possibility for short-term pain is still there. Um, the big
Especially
thing
as
though
we
is
near the 2 week ceasefire with no deals. Like that's gonna act as sort of some of those tariff deadlines did. Remember after the initial like, all right, we're gonna push back the after Liberation Day, we were like, oh, we're gonna push back the deadlines 2 weeks or whatever, and sometimes those would elapse without any deal, but more often than not, they would have a deal. This is ending a war is going to prove a lot trickier than just pushing off a tariff deadline, I think.
well, and the other part is, I mean, just remember what like the context of the market was before Iran. It's not like the market was sailing higher and everybody was super bullish, and then the Iran news, the Iran war started, and everybody got terrified, which would have been like the Liberation Day analog. The market was capped out and had been trading sideways for months, right?
Yeah.
And we are now just back into the very bottom end of that range. I don't see any reason for the concerns that were driving the market 2 months ago or 5 months ago. I mean, those haven't really resolved in a meaningful way. The Fed's probably, still not cutting rates. We'll talk about inflation and prices and stuff like that a little bit later. But like the AI risks are real. The CapEx spending is real. Um, I think you could maybe make a case that like new AI tech and more promising developments there, or maybe better earnings get us up and through
Yeah.
that
It
end of
is
the year
coinciding
range.
with the new earnings season, which could help.
Yeah. But like for the time being, I think we are still capped to the upside. I think this was a big relief rally. Um, Mark Holbert said that there was never a contrarian signal from market timers. So we never really hit max pessimism,
Mhm.
which doesn't validate this rally quite the same way as if there was a washout. We didn't get the washout. But I mean, it's one of those things where it's like, well, yeah, he hits 350 against lefties in the rain. It's like, okay, well, if you pare down your statistics far enough, you can say anything you want. But this definitely felt like a relief rally and not something where people were panicking. And we were saying that weeks ago. This wasn't a panic market. This was everybody sort of deleveraging. So I think this range is still going to be our ceiling for the foreseeable future unless we get a change to fundamentals, new tech, better earnings, or maybe SpaceX IPOs in June and then we get a blow off top and then that's it. I mean, who knows?
Yeah, I mean, I think if I were to if I were to bet, which I never would on this, I'm not on Polymarket. Um, I think that we've maybe seen the bottom in the S&P, and possibly the Nasdaq. S&P never quite hit correction territory. It was close. Nasdaq did, but it was only what, maybe like 11% from its highs. Although that was more of a slower burn that started all the way back in October. Um, I think you might be right. I don't think we're just going to have the V-shaped recovery that we had starting last April, post Liberation Day. There's just too much up in the air. I could see, what Mike calls a shakeout, in us getting not quite back to those lows. If we can start establishing higher lows, in the coming weeks, month, that'll be an encouraging sign. And I do think earnings could help. Didn't help much in, the last quarter, despite another quarter of double-digit earnings growth. But that was with the market, at least the S&P, coming off of all-time highs, or still right around all-time highs, where now it's not, despite the recovery this week. Yeah, I guess I'm sort of in between you. I'm a little more optimistic, but I don't I don't think we're just gonna go straight up from here.
Yeah, have you seen the stages of a bubble chart? You've probably seen it, but you may not know the chart title. I didn't. Stages of a Bubble. It was Dr. Jean-Paul Rodrigue. I don't know. He published in 2008 and was the one that says like take off, sell off, bear trap, enthusiasm, greed, delusion, new paradigm, denial. And so it's like it's following this
Mhm.
major peak, and then it goes back to it like a return to normal, and
Yeah.
then fear, capitulation, despair. I don't know if we're in like the blow off phase. Maybe we're in that return to normal phase when we had lower. I don't know. I think fundamentals matter now these days. Now that everybody's sort of taken a breather and had an opportunity to deleverage from some of the hype stuff, I think people are probably going to be looking around and being like, okay, well, what's the next thing? Is it going to be AI? All signs point to it being the best of some limited options out there, but I don't. Yeah, I mean, bears have predicted 150 of every of the last like 10 market crashes or whatever that saying is. Right?
Yeah.
Like I'm not going to say like market crash coming or anything like that, but there's a little bit of that rally came with a lot of complacency. It was across the board. It wasn't really selective. Um, I just don't know. I don't know that we have room to run. I mean, I made a case for it months ago. Like, hey, 7,000 is like a generational top. And I think that's still in play. I think the valuations are just so high. And thus far, all like GDP just came in. It was up. They revised Q4 GDP. It was up 0.5%. That's pretty much all data center build out. If the only growth in the economy is coming from building data centers, that's not a robust economy that we've got going right now.
Well, speaking of the economy, let's get to the CPI data, inflation data that came out this morning. 3.3% year over year is the headline number. That's the highest since 2022. Not a good year to be comparing to. But there it comes with some real caveats. Obviously, oil prices are the biggest part of that. Um, if you strip out food and energy and go with core, it was 2.6%, which is, I think, slightly less than what was expected. 2.7% was expected. And actually, that 3.3% number was less than the 3.4% that was expected. So that's why you're not seeing panic in the market. Market's basically flat so far this morning. Um, I don't know. I think this is just about what you would expect with, $5 gas prices, and sky high oil. Uh, I think this is sort of, falls into the taking out the energy piece, falls into the fine category that we've been seeing, well enough category that we've been seeing with inflation, not quite down, close to 2% like the Fed wants, but, you know, on a core basis, being at 2.6% is not too bad. But the longer we see high oil prices, meaning, the longer the war goes on, the longer oil will be around $100 a barrel or more. Gas prices up about $4 a gallon or more. I think that'll spill into other, aspects of the economy. But 1 month of this, I don't know that's overly concerning. What about you?
Yeah, I think that's right.
Yeah.
This was everybody knew it was going to be high.
Yeah.
Oil prices have what nearly doubled, or at a few points had pretty much doubled.
Yeah.
Um, in the last few months, everybody knew energy was going to be coming in hot.
Mhm.
PCE, which was reported earlier this week,
Yeah.
0.4% month over month, up 2.8% year over year. Like that's that still high, kind of sticky inflation that we've just been muddling through for a long time.
Mhm.
Where inflation starts being everybody is saying, okay, well, the short-term impact of the conflict, don't worry about this one. Well, if it's still an issue in 3 months, right? Like if we start seeing food prices rise because of higher input costs from like fertilizer that's not getting through the strait, farmers, I think just now are buying fertilizer for like the spring planting season. So some of those costs haven't matriculated through. Maybe towards the end of the summer, if inflation is still high and people are like, okay, well, maybe the Fed will cut rates again in 2027 or 2028, right? Like if it reframes everybody's sort of baseline expectation and ends up being stickier than I think the market is treating it, that's maybe when people start worrying about this. But it's also not it's one of those known unknowns. We've been dealing with moderately high inflation for 3, 4 years now,
Yeah.
and everybody has just sort of muddled along, and the pot temperature has risen, and the market frog has not is accustomed to it now. So if we just have persistently slightly higher inflation, it's not. I don't think it's coming out. I don't think it's going to surprise anybody. Uh, so bad prints, but expectedly bad.
Yeah. I mean, the real thing that the number that came out that speaks to what you were just talking about with, market possibly being capped, at least, in the near term. Consumer sentiment came in at an all-time low. Uh, let's see, this is another reading this morning. University of Michigan's index consumer sentiment fell to 47.6 this month, lowest reading on record. Drop of 53 from 53.3 in March and 11% down even from this time a year ago, which was around Liberation Day. Um, that's not good. Uh, so it's why it really is remarkable that, earnings is still at double-digit growth for what, 5 straight quarters. I mean, a lot of that is AI and data centers. You wonder how much longer that can keep up, which is why I think this earnings season is pretty pivotal.
Yeah. Well, I mean, like you and I have talked about the when will consumer pain impact the market, and until something breaks, I don't know that it does. I mean, the market doesn't care about a consumer's ability to weather high price, like the high costs associated with the conflict in Iran, right? Like
Yeah,
that's not a consideration. It's is there money being spent somewhere? And for the time being, there is still a lot of money being spent. It's just being spent by big tech companies,
right.
and it's going to, or lenders to big tech companies as they are increasingly taking on more debt. I think Amazon just had a big debt sale. But until it's bad enough to break something, the market doesn't care.
Well, one area of the market that is having a moment right now, it's a very specific niche, is space. The last couple of weeks, we mentioned SpaceX filing its IPO for possibly June, and how big that could be, over $1 trillion market cap to start potentially. And then, the Artemis 2, successful circumnavigation of the moon. Got a lot of people were interested in that. Well, whether it's a combination of two or mostly just SpaceX, space stocks, which is a very limited sector, are up very sharply this month. ASTS, which is one of my favorites, that's up from 73 to 96 just in April. Now, granted, it had fallen from the 90s prior to that in March, but quick rebound. And then uh, PL, which is Planet Labs, that's up more than 30% in the last month. And then Rocket Lab, your baby, not up quite as much, but that has rebounded nicely in April. A space analytics firm Hawkeye just filed IPO. As revenue apparently jumped 74% in 2025. So space is having a moment. Would you invest in space right now?
No, no, so
Wow, you're
Virgin
really cranky today.
Virgin Galactic, SPCE, they're up 26.2% in the last month. They don't do, I mean, they're like they've been an also ran for years. They came public back in like 2019. They hit a 2021 everything bubble high of like $1,100 a share split adjusted. They're trading at 308. They're down 98%, 98.5% all time from their reverse split adjusted IPO price in 2019. They're up 23.2% right now in the last month. There's no reason for them to be rallying. They don't earn money. They don't do anything. Um, Lunar Intuitive Machines. I don't know if you remember, they launched a drone to the moon and then it just like fell over sideways and it
Yeah.
didn't work. They're up 90% in the last 6 months.
Yeah.
They are up 141% since coming public in 2023, it looks like. So, but these are like knock-on beneficiaries of a lot of interest in space. If you look at the going back sort of to the SpaceX of it all, um, SpaceX is now a government contractor, right? But the bulk of their upmass, the stuff that they put into orbit is Starlink satellites.
Yeah.
That's like 90% of the stuff they put into orbit is Starlink satellites. Starlink only has like an annual revenue run rate of like 6.6 billion. Starlink, their biggest customer, doesn't make enough money to stay in business. I don't know what justifies this kind of valuation. Um, the ASTS Space Mobile, I think their tech is cool. Do I need 4G service in the middle of Nebraska? No. Do most people? Yeah, maybe some, maybe. Is it going
Yeah,
to
but
be
you
better?
know on Wall Street that it's all about the story more than more than the revenue until it gets to a certain point. A lot of these are still in the romance phase.
Well, the other thing, just from a mechanical standpoint, is let's say SpaceX IPOs in June. Are people going to want to jack up their portfolio level space exposure? No, they're going to sell these beneficiaries and use the proceeds to buy SpaceX. Or if SpaceX tanks on its IPO and nobody wants it, these are going to have they're going to sell off as a knock on because the story will be, oh, space isn't the place to be anymore. This very much feels like a buy the rumor, sell the news leading into that SpaceX IPO.
Yeah.
Um, the Artemis flyby was, I think you had mentioned in our notes. That's cool. Doesn't doesn't do anything for any of these companies
Project
right
Hail
now.
Mary out in theaters last 3 weeks, $433 billion worldwide. Space.
I love space.
Yeah.
I'm a science nerd. My baby is these days, and as has been for a while, is Redwire, just because they do a bunch of investigative science, but the performance isn't there. It is probably the worst performing space stock out there, even worse than the guy than Intuitive Machines, who landed a drone or a probe on the moon sideways. So that's obviously disappointing, but I'm not buying space at these levels.
I agree with you in some cases. Yeah, like Virgin Galactic, no. Um, I, well, I may have even mentioned at some point in the podcast, but one of the stocks we've mentioned before is one of the best, basically has been the best performer in my Stock of the Week newsletter for the past year and a half. So pretty high on that one. It seems like I think you're right, the buy the rumor, sell the news thing. But I also think I think I would not invest in the SpaceX IPO, especially at the levels it's going public at. But I also think that SpaceX will ultimately be a good stock, a growth stock. And so whatever weakness it has early on and whatever, that does to fellow space stocks, I think it'll be fairly short-lived. Um, so, I think pre-SpaceX IPO, very short-term space is a buy, but I also think some of these space stocks are a buy if you're looking out a little longer term. There could be in between those two things, there could be uh some weakness. But I don't know. I think if you buy the right stock, I think space can be a good investment.
Yeah, the other thing that makes me sort of wonder is like government is spending $88 billion a year or a month on interest. It's more than defense, and I think healthcare, maybe defense and like government pensions, something like that. But like with government spending being super high, who's paying for space? Who's going to be paying for space launches in 2027? If we're already making discretionary cuts for a bigger defense budget, is space going to be in there? Maybe, right?
Yeah.
Like if space becomes a potential like vector, a combat vector or a competitive arena, or if there's like a new space race because China's going to try and put a base on the moon. Russia, I think, just laid claim to some lunar territory or something. Right? If we get a new space race, all bets are off. Buy everything that has space in the name.
Right.
Uh,
I don't think
but
I'm not ruling that out.
I think the economics of most of these companies don't really work. I sort of made a case for SpaceX and for Starlink specifically. But if everybody with disposable income is throwing it into data centers, who's paying for space launches?
Yeah.
It's investors right now, but they don't have an unlimited checkbook. So we'll see
Yeah.
what happens with those.
Okay, we are going to welcome on our guests in just a second. Before we get to that, though, I wanted to mention our offer today. If you go to cabotwealth.com/street, we have a new investment advisory from Jacob Mintz, frequent Street Check guest and our options trader, options trading veteran. He's launching something called Cabot Options Trader Essentials, which is basically an options trading service. He has several already, but this one is for beginners or more beginner friendly. If you're wanting to get into options trading or have dabbled and want to know more, Jacob is great at options education, and we're offering this service, which launches basically this weekend, for $497 for 2 years, or you get it for 1 year at $247. And it's a good way to learn about options trading, get some very profitable options trades. Jacob has a very great track record through his other trading services. You can try it out for 30 days. You get 100% money back guarantee. And yeah, I think this is, I think given Jacob's track record, you will make that money back pretty quickly. And it's also, there's no better teacher of options than Jacob. So again, go to cabotwealth.com/street to get your special offer of Cabot Options Trader Essentials. Okay, we'll take a quick break and then we welcome on our guest today, Mish Schneider. All right, we welcome on for the second time Mish Schneider, who is chief strategist at MarketGauge.com. Been frequent appearances on Bloomberg and Fox Business, CNBC, Yahoo Finance. Mish, you were on here a little over a year ago. Lots changed in a year. Lots changes every week. Been a
Every
good week
minute.
for the market. Yeah, good week for the market amid the ceasefire. Where are you mentally as an investor? What are you advising your clients right now amid all the sort of chaos?
Well, a few days ago was a much better entry into the market than getting in, say, today as we speak,
Right.
after we've already seen this massive rally. Because I actually do believe that we're going into some kind of a trading range. And when people want to say put numbers on that, I would say I don't think we're getting over 7,000 in
Mhm.
the S&P. And I do believe that we could even fall as much as 6,000, although, we've sort of seen this floor now at around 6,400. And that's how I think you have to approach the market. Not that there isn't going to be stocks that are going to continue to rally, go to new highs, others that will continue to just sort of flounder. But I do believe if you have that mindset that any great big dips, once they sort of settle, not on the falling knife aspect of it, but when you start to see some settlement, some buying coming in, and some follow through, like from one day to the next, probably the best time to get in with a very tight risk. This is all about risk management right now, this market. And conversely, if you start to see this massive rally like we've seen, with now the Dow down a little bit here, S&P's over 6,800, but not really looks like the momentum is sort of starting to die. Good time to take some profits. And I think that's how you have to kind of look at it. If you go back to the 60s, it's so interesting, Chris, this is the year of the fire horse. And I know people think that's kind of woo-woo, but in Chinese philosophy, which has been going on for thousands of years, they look at not just the horse or the rabbit or the snake, they look at the elements. And this is double fire. We've been in a period of water for years. And double fire horse hasn't happened since 1966. And if you think about 66, what was going on in 66, right? We had the Vietnam War. We had really the start of a younger generation looking at things differently. And even though we're not going to model exactly the same, but we actually also started the space program at that point. The Russians actually beat us to the moon back in the 60s until we got there. You know, we had some good biotech innovation with the first artificial heart. So it seems like this is a year where you'll see great innovation, but also a lot of volatility, right? So duh. I mean, that doesn't take a genius to figure out we've already experienced that. So I think that's how you have to kind of, to use a pun, saddle up for this year.
Right. So you're looking at maybe a ceiling, right? And where we were earlier this year and at the end of last year. How long does that stay in place? How long are you looking at this range and seeing like a top? Like what's the catalyst that gets us up and over that hump?
Well, number one is an aversion of some kind of a recession, which right now, to me, almost seems, hey, I'm sorry, dog barking, almost seems inevitable that we will head into some recession. Why? Because first of all, let's follow the track of the 60s. Secondly, as people are starting to talk about some kind of a hyperinflation, which, by the way, we have not seen hyperinflation yet. People are predicting it. But we know that we have a unique situation in that the Fed is not going to raise rates into this inflation. They're just not going to do that. They can't do that. Instead, if they start to lower rates, what we're really talking about here is, I think, fear that we're seeing a massive economic slowdown, which hasn't actually hit yet. So that to me tells me that number one, we have to see the cycle play itself through, and we're not through that. Number two is we don't know what's going to happen in midterm elections. So it could be not 15 years, 68 to 82, by the way. The Dow just traded in a range. Do I think we're going to go from like 2026 to 2040? No, because everything is accelerated. But I do think that we're starting the trading range idea now, and maybe we go until a couple of years into whatever the next administration might be, 2030, let's say. That's kind of where I'm looking at it for, which will be frustrating, but I think people have to be prepared for it.
For this being like a decade top is...
Yeah, exactly, which is exactly what happened in the 60s by, you know, the nifty 50 in the 60s. So now we have all these big software companies kind of experiencing maybe something similar.
Among the many concerns of the market right now, I know the private credit crisis is one of them. How concerned are you about that, infiltrating the market and certain, financials in particular, and how concerned should investors be?
Well, if you're looking at price, which obviously is always going to be the key indicator, and you're looking at something like regional banks, for example, which I like to look at KRE, which would probably be greatly impacted, not just the big banks, but the regional banks by some kind of a default because of private credit. We're not seeing it yet in the numbers.
Mhm.
So if you're asking me how concerned I am, I'm not that concerned at this point. However, if you look back at 2007, 2008, it took a while for things to start to unravel, and you get any kind of Bear Stearns moment in that, then you will start to see it in the numbers. So I'm not as concerned about that as I am more about the consumer side of the US economy. That to me is probably the key to everything, is can we see the consumers hang in there given the rising prices of oil, the rising prices of food, given the fact that confidence is way down, given the fact that even before the war, they were tightening their belts, given the fact that interest rates haven't quite come down. And of course, we know that credit card interest rates are really high and the savings rates is starting to finally go down. So that to me will tell us first, before anything else, whether or not this rally is going to be short-lived, or whether or not for some miraculous reason we see the consumer come back into it.
It's interesting. Chris and I, just before you had come on, we were talking about when will Wall Street care about the consumer in the context of of inflation. And, my sort of callous take is Wall Street generally doesn't. But it'll take something breaking. Where do you see that the impact on the consumer maybe showing up first? Is it coming in defaults? Is it coming from auto repossession? Like what's that metric that you're looking at to say we should be paying closer attention to this?
Well, I think you have to look at the labor market as well. And of course, we just saw the jobs report look pretty solid. But, I wonder, well, first of all, I'm always sort of suspect of numbers that come out anyway. I mean, that's just the nature of the beast. I have been since I was a commodities trader many, many moons ago. But I think you have to watch the labor market and you have to see the participation rate. Number one, we saw the JOLTS actually showing some stress. And I think that could affect, because if more people lose jobs, obviously that's going to impact the consumer. I think you have to look to see what happens here. Gas and oil is one thing, and we know that is a pressure, but it's not at the point yet where people are they're nervous, but they're not freaking out. I think the food prices coupled with the oil prices could be the real catalyst. And again, will it be hyperinflation? No, but it will be just enough to make the consumer really basically scale back on everything. Travel, going to restaurants, consumer discretionary. We could see like a stock like TJ Maxx just went flying, but TJ Maxx was really basically not a consumer discretionary stock because a lot of that buying is coming from a completely different consumer, which we can talk about, which is the vanity trade. People that have lost a lot of weight because of the diet drugs are going out and looking for places to shop that are discount. But nonetheless, getting back, I think all of those could break the consumer. I also think that if housing prices coming down can't be matched by interest rates coming down and people can't get loans for things, starting businesses or whatever because of the high interest rates, all of this is putting pressure on the consumer.
Are there stocks or sectors that you like in particular in this current sort of uncertain environment?
Well, I certainly like commodities. We were really, really bullish in the metals coming into this recent rally. And now we're seeing more of a trading range, but it could be setting up. The silver and gold could be setting up again. I don't think I would jump in like, let's say, today.
Right.
But I am looking to see if gold can get back, let's say, over 5,000 an ounce. If silver can get back over $80 to $83 an ounce, that's probably saying that they're ready to pop again. Obviously, if you're looking at oil and gas, natural gas has been the biggest head scratcher of everything. It's so freaking cheap. It's at new yearly lows, the price of natural gas. And I'm not really sure why. I know people say there's a lot of it, but we know that producers are not going to be so willing to produce at these low levels. So I would look at oil. I mean, if we can get back over $100 a barrel, I don't care what the narrative is in the Middle East, that probably means that oil is going to continue to go up. And then if we go to just sort of the aggregate of food commodities and you look at DBA, we're long DBA, we think DBA has potential. If we leave the commodity space, I like crypto. I'm really keen on crypto here. Yep. We've been consolidating for months. We've taken out the moving average, the 50, after a long time of being beneath it in both Ethereum, which I'm interested in, and Bitcoin. And so I think you could look at things like Bitmine, for example. We already have a position. And then outside of that, I like some of the biotech space in particular. Not every single stock in the biotech, and I think you have to be careful about fear of tariffs on pharmaceuticals. But nonetheless, very innovative, as we were talking, the immunology and also antibodies is the new buzz in biotech. And I think looking at some of those companies like Oscar Health, RxRx, there's the ADCT is another one. And then immunology, Moderna's been doing some really cool stuff. So I like some of the biotech space. I think you have to continue to look at semiconductors. I mean, right now, they made new all-time highs yesterday, but you have to be selective and maybe hold off a little bit here at these levels because it's a little high coming into earnings. And then finally, I do believe that EVs have been, I'm not saying Tesla because Tesla's got its own host of problems, But, we've been talking about Rivian for years, and every time it breaks down under 15, it looks like a buy opportunity. If it can ever get over 17, I think solar is going to come back along with some of the other energy like lithium and uranium. But and this vanity trade that I'm talking about, because that niche of consumers, so Eli Lilly, Novo Nordisk, they've come off a lot. They're much more attractive at these levels. As I mentioned, TJ Maxx, but you also want to continue to look at Elf and Ulta Beauty, the places where people will go regardless of what the economy is doing. And that kind of gives you a good stretch. Other than that, cash is okay for now. And by the way, we have to watch the dollar too. We can talk about that.
Yeah.
Did I give you enough?
Yeah, that's great.
I'm like a machine. I know.
Yeah, no, that was fantastic.
I like Micron and AMD and all these things, but they were much more attractive to me, like at the beginning of the week, than they are right now at the end of the week.
Right. Brad, you had something?
Yeah, the crypto thing is interesting. That's one that I have been kind of side-eyeing. I think Chris and I talked about it a couple of weeks ago. It's like, man, Bitcoin has been really resilient in what has been a really tough environment. And frankly, I don't have a great explanation for why it has been holding up as well as it has been, because it's just like a leverage play. Our assessment is leverage play on the broader market in general. But the fact that it's been holding up well, I wonder if maybe if you're eyeballing something like a Mag 7 or a software stock and you want sort of a related play, of maybe looking more closely at crypto is a better way to play it.
I think so. The way I always like to phrase the whole crypto space is it's part of my economic modern family, which I know we're going to talk to later. We call the character Crypto Bro. And Crypto Bro is a tween, right? I mean, how long has crypto been around? Really, we can say like around since 2008, 2009, really, when it started to get popular. And mass adoption has been great over the last couple of years. So I always say it's kind of trying to figure out what it wants to be relative to the economy when it grows up. And maybe now we're starting to understand that better because of fiat currency and the problems with fiat currency, because of the distrust of government that's happening more and more. We're even hearing now that the Strait of Hormuz, Iran is considering the fee for passage in crypto as opposed to dollars. And that's a whole other host of problem. And of course, with stable coins coming more into play and real world assets being able to be digitized, there's like a million reasons why we could think that we're starting to see that departure between regular equities and now cryptocurrencies, as it's not necessarily a risk asset anymore, but a go-to. And that kind of excites me in a way, because I think it is the future.
You mentioned economic modern family, which is something that initiative that you have through MarketGauge. Explain what that is.
So many years ago, when I was a commodities trader, right? I was a commodities trader on the floor in the New York Commodities Exchange for a long time. And then when I got involved with MarketGauge and I started looking more at stocks, because commodities kind of went through its long period of being asleep, I had to teach myself about equities and how things related to the economy and sectors. And because I have a background in special ed, I started thinking of them as human beings. So my first character really was Grandpa Russell 2000 as sort of the granddaddy of the US economy.
Yeah.
And I even started, I have some, acting experience. So I started thinking of the backstory, right? So he's from North Carolina because it's used into industrial manufacturing in the US. And he's, kind of a cute old happy guy, always happy. And then who was he married to? Grandma Retail, Granny Retail, because 70% of the GDP is, of course, the retail space. And that's how it started. And then I extended the characters from there. Sister Semiconductors, Big Brother Biotechnology, regional banks, the prodigal son, transportation, my Tran character, and crypto came out later. And so altogether, we have 7 characters. And even though it's not every aspect of the economy, there's no real estate character, for example, they are all impacted by everything. So they can speak to it. And so I started to tell myself stories. Oh, Granny Retail's not very happy today. Oh, Grandpa Russell forgot to take his Geritol, that kind of a thing. Or, wow, look at him hurtling over, he's having this new life. So we created characters. And now, because of AI, we are animating those characters, and it's becoming an education tool.
I love it. And sort of a spin-off of that is your youth financial literacy series that is underway or is about to get underway.
It's underway. We have pilot episodes. We have
Okay,
not released it to the public yet.
gotcha.
Everything else I'm talking about, you can see on our YouTube channel, The Economic Modern Family, and watch the animations. They're so fun. They're exactly how people want things to be delivered to them. Short, fast, fun, vertical, on your phone. And in under 60 seconds, sometimes under 40 seconds, you get a real lesson or a commentary about what's going on. So yeah, the children's literacy is more going to be like soup to nuts. How does money flow? What's your relationship to money? Let's talk about hope, fear, and greed. Kids understanding that, and then really going more into understanding the sectors, because the Modern Family is teaching them. And then really going more into like, how do you trade? What's a moving average? You know, what does it mean to look at momentum and volatility and, you know, certain other types of indicators, all the way to the point where they can actually make a trade. That's where we're going with this.
That sounds great. And most of our audience is on YouTube. So, you know, after watching this, you can flip over to the Economic Modern Family YouTube page. And you can also find more from Mish at marketgauge.com. Mish, thanks for joining us. We should make this an annual thing. This was great. And you know, I'm glad you're joining at you know, when things are a little more positive than they were, say, a week ago, at least temporarily.
Yeah, well, I want to leave with this because I think this is really important. Number one is you have to watch the dollar, obviously. If the dollar right now, which is having some issues here under the moving averages, continues to decline, that's a host of problems. Number two, you have to watch the long bonds because right now they have been holding also in a trading range, holding up very well in the face of people so worried about inflation, which tells me that there's a good chance that the bonds rally and the rates drop. And what does that mean? Is that yay? Or is that, oh my God, heading to the recession? And finally, like I said in the very beginning, you have to watch the consumer sector, and you can look at XRT. That's my ETF of choice because it's discretionary and staples. It was the first to drive the market down. It was the first to show some kind of a bottoming formation. And now it has not been able to clear the moving averages when all the other sectors did, or mostly all the other sectors did. So if it starts to roll over, I think that's fair warning as well.
Okay, yeah, XRT. That's a good one to watch. Thank you again. I really appreciate you joining us again. And
Thank you. So good to see you, Chris and Brad. Yes, I look for, I guess,
Thanks.
a year from now. Yeah, we'll have a
yeah,
whole other conversation.
do it all again next year. It'll be a whole new world, I'm sure. Thanks again, and thanks to everyone for joining us on Street Check. We'll see you next week.